we're now hearing from Wall Street firms and others that the Fed is likely to make at least 4 moves, 4 hikes this year. Is that enough in your view? Are they going to be able to catch up from being behind, at least in your opinion?
They don't know. I don't know. I think the Fed's principal error in this cycle is to arrogate to itself the idea that it is in charge of events, not conceding that events actually have been largely in charge of the Fed. And I think I can interpret Senator Sherrod Brown's remarks, and they are exactly 106 or 7 years old. Around the time of the founding of the Fed, Carter Glass was railing. He's the founding senator of the Fed. Carter Glass was railing against Wall Street and against how the Fed would certainly stand up to the concentration of financial power and to the excesses of private finance. And here we are, 100 years plus later, and we are hearing more or less precisely the same ideas, arguments, with this difference that under the Fed, interest rates, as determined in the marketplace, are now receding fast, and in the rearview mirror, we have not had them for many years. And I think that is something that Chairman Powell ought to be asked about. Whatever did happen to interest rates, one might ask him. We miss them. Certainly the thrifty miss them.
Yeah, people who are reliant on income they might get from savings accounts and other places like that, CDs, are probably missing higher inflation. But there is a price to be paid by consumers if you're watching mortgage rates climb, which we have over the last week pretty significantly. If you're going to start paying higher credit card interest, if you're going to see other places like that. So the battle that Powell's going to be facing today before the Senate is to try and explain that inflation can be a bigger problem for the masses than higher interest rates itself.
Yeah.
Do you think he'll be able to make that point?
Yeah, of course, there are 2 kinds of inflation that we're dealing with. One is the very pleasant Wall Street variety in levitation of earning assets. And that is, for many people, not at all a problem, but it's a pretty fine livelihood. But that is on a collision course, it seems to me, with the more newsworthy form of inflation, that of the CPI. So how do you navigate that? The Fed now is talking big about its 3 or 4 rate rises. It means to shrink its grotesque, its large balance sheet, without doing that, without upsetting the financial structure, which is highly leveraged and quite precarious for that reason. One symbolic, but nonetheless, I think, striking and indeed important feature of our financial landscape is the leverage of the Federal Reserve itself. It is a bank, and it has assets and it has capital, and the system itself is leveraged more than 200 to 1. And the flagship branch of the Fed, the New York Fed, is leveraged 316 to 1. That's compared to like 10 or 12 to 1 for the big banks such as JP Morgan Chase. So this only is a reflection of the immensity of the Fed's intrusions and of the widely but little remarked turn that Jay Powell himself made in the past 10 years. When he was a newbie on the Federal Reserve Board as a mere governor, this is 10 years ago, he said, more or less, quote, he said, I really do think that we are actually at the point of leading people to take more risk. And he enumerated some of the excesses that the then new QE program was introducing into the marketplace, such as the, we call it the toppy private equity markets and the like. And here we are 10 years later, and really nobody is asking him about the structure of finance, of the indiscipline in finance, and of the Fed's contribution to that indiscipline. I mean, it's a daily chronicle on CNBC and elsewhere, and my goodness, NFTs and cryptos and venture capital, public venture capital, zero profitable tech firms, that whole index of them. So how you raise rates to suppress the inflation on Main Street without upsetting the apple cart of inflation on Wall Street is a very good question. And I do wish someone would ask the chairman